Hello, everybody. This is the middle of the year 2024, and I'm John Blank, Zacks Chief Equity Strategist and Economist. So I wanted to get to the middle of the year and do an equity market update. So today I've got three parts to my story. One, the major part, will be the S&P 500 market weight index dynamics. We will look into the equal weight and the market weight. We will look into the mega caps as well as the small caps. But my main focus will be on the S&P 500 market weight. Number two, I will go through the middle of 24 macroeconomic setting for the U.S. I won't touch the world economy since I'm only focusing on the S&P 500. However, 40% of the S&P 500 revenue does come from abroad, and we are seeing a strong global economy. So that's good news. Part three, consumer price inflation and bond rates, Treasury bond rates particularly. I will not touch upon corporate bond rates, but I will want to get to the story of inflation on the back end, and I do want to break it out from the overall story of the U.S. economy because it is a unique and important subject. So before we go any further, let's go through the disclosures. These are the views of me, John Blank, and I do have a PhD from MIT in economics, and they are not necessarily the views of Zacks Investment Research. Keep that in mind. The rest of this you can read at your leisure. Okay, so number one, like I said, I want to get through the S&P 500 dynamics at mid-year 2024. So let's start off with the Zacks S&P 500 Price Momentum Index. I'm looking at 2021 to 2024. So this is the post-COVID bull market that we have seen. Now, you should have been buying in the green period. That was back in the second and third and fourth quarter of 2022. So out of opening, this was the area where there was a trade to be made in a oversold situation. Green will indicate oversold. Those were the times when you should have been buying if you're looking to get this right on a longer term basis. Of course, the momentum was poor at that time, and this was when the Fed started hiking rates. That killed the market. However, looking back, that was certainly the time. Now, red means overbought. And I want to point out in the first quarter, we did see some overbuy, very modest. And then we get that pullback big back in April. And now we're back up to the highs here in June. So good news is we're not overbought right now because of that pullback. So remind yourself about that spring pullback. It really gave us a nice refresh. It took a month out of the market and kept us back to a nicer position from a momentum perspective. So I would worry a little more about this market at mid-year if we had some red, but we don't. It's basically a very quiet summer market here. Keep that in mind. Okay, so the S&P 500 broad index market weight versus the growth index. It's a fascinating chart. It's 10 years worth of data. You can see how we came out of that period, and the growth index really outperformed in the COVID pandemic with the quantitative easing that the Federal Reserve was running. And then you can see generally the growth index has always performed better over time, but has not been the case of late. The growth index and the S&P 500 index are in lockstep. Why do I think that's happened? I think it's composition of the growth index and the power of the mega cap stocks, because they're now so dominant in this index. They're taking these two indexes to the same place because the growth indexes are the mega caps, and the mega caps make up so much of the broad index. So that's my point. The mega caps. I only got 5 here. I took Tesla out, and I don't have NVIDIA. And of course, NVIDIA, absolutely critical for this market. But let's talk about what's rising and what's not rising. Here we've got Microsoft, which is rising, and we've got Google, which is rising. What is not rising, of course, has been Apple, which is getting back to its highs, and Netflix, which is now another bull market for Netflix, but it looks like it's pulling back. So really, you've got Google and Microsoft. So what is that? That is the data center projection of time that we're going through right now. We're getting the Google, Microsoft, and Amazon data center game, and it's getting mixed in with the Apple and Netflix stories. So remains to be seen about Netflix. If it keep its momentum going in streaming. Streaming is certainly the case. Cable television is facing major competition. Everybody knows that. Apple, we'll see what happens here. It's getting back to those highs, but it's been touching those highs 2 other times. So looking like a top's getting put in for Apple at this point in time. So we'll take a look at the rest of this. Keep in mind, this is the story of the major indices and where the profits, of course, have been. Okay, so we're going to get into price to cash flow valuations. This is over the last 20 years. I just want to point out some interesting thing here. Free cash flow is continuing up, and it's holding up at a very reasonable pace. And you can see free cash flows per share in the S&P 500 are actually in alignment. So this is a market that is trading on its fundamentals in terms of free cash flow. Keep that in mind. Cash flow to the S&P 500 and free cash flow per share does not matter. We are getting motion. Now, you can look over here and just see how overvalued we were going into the financial crisis on price to free cash flow. That is certainly not the case here. All kinds of good news here from a cash flow perspective. So if you look into cash flow yield on a sector basis, what do you see that's really hot? Interestingly enough, energy market with a 16% free cash flow yield. Crazy story here, super undervalued energy market right now. And we see it, the next place is the telecom market, which has got a 6.8% cash flow yield, then the materials at 5%. So the energy, materials, and telecom stocks are the most cash flow rich, and they are keeping the whole story up. Now, if we look at Infotech, the 5% high, 2.5% low, and right now it's at 2.6. So the actual Infotech cash flow yield is extremely low here currently. I misspoke. Energy is now at 8%. Telecoms are at 4%, and utilities are 4%. So same story, but basically my point here is Infotech is not where the cash is. It's in energy, materials, and telecoms. So fascinating thing that's going on here. I have no idea what to think about all of this, but keep in mind, this is what's going on in this area. All right, the equity forward 12-month valuation and the equity risk premium. I just want to point out here, here's the equity risk premium. It used to be at about 6 back in 2014. And it spiked to 8.5 in COVID, and then it got back up to the 4.5 area in 2020 when you should have bought and you didn't buy. And now we're down here at really, really low values. So this is extremely overbought situation from an equity risk premium perspective, but not so much from a valuations perspective. We're now in a forward 12-month PE of somewhere around 20 to 21. It's certainly not cheap. And certainly higher than before, but that is the story of this market right now. It's an AI-driven euphoria, valuation expansion is the story fully. All right, so from the value view back to the forward value view. There's the dividend yield, incredibly low. Price to book, kind of always getting stronger here. And then you've got price to forward PEs. This is interesting in the sense you can see the longer term expansion of the multiples. I assume this is a lot to do with the quantitative easing and the amount of money that's been parked out in the world. $7 trillion on the balance sheet. It's just driving up that multiple over the last 10 years. Keep that in mind. I mean, it really is a long-term story here, and it's driving down valuations on the dividend yield perspective and up on that one. So keep that in mind. Middle weight. This market weight here and equal weight over here. So this is the equal weight, and this will carry up with the mega cap story because it's market weight. Market weight will capture that. And of course, you can see this is currently at 22.4, and the equal weight is at 21. So one way to look at this is that's basically driven by this or this, and the valuations are going up for both. Keep that in mind. If we get rid of the market weight effect of the mega caps, we still get a pretty overvalued market. But like I said, these are long-term trends that the Fed probably put in place, and I would not bet against the Fed. And the Fed is now what you need to think about in terms of its quantitative easing and the amount of sheer trillions of assets to put out there. All right, sector PE ratios. Back to this story, I just want to point out the current highest one is Infotech. Like I said, the cash flow is extremely low there, and the PE multiple is 31, extremely high. And of course, down here, materials, telecom, and utilities are at the low end. Financials is the lowest. And that is really the story of this market here. You can see, just let's look at that Infotech thing. It is really, really extreme right now. No other way to say that, and be very careful with that particularly. All we're doing is driving up the valuations of the Infotech stocks. PEG ratios. So PEG ratios, you'd like to be below 2 here. So do we have one below 2 for Infotech? It's at 2.2. Actually not so bad because the growth metrics are pretty good. So there might be a 10% or so overvaluation in the Infotech space. Not so much that I would consider that out of line. Consumer staples, really an overbought sector relative to its growth potential. Kind of keep that in mind. And actually down here, what's interesting is the consumer discretionary stocks in our area are actually in pretty good shape. Keep that in mind. I mean, industrials and consumer discretionary are actually PEG ratio wise, and financials are all the ones to be in. And then materials, of course, the lowest. I would question this scenario, what's going on here. I'm not quite sure. But keeping this in mind, that basically Infotech's at 2.2, maybe 10% overvalued from the PEG ratio. And there is a lot of strength here in areas that you might not have thought about in a PEG ratio perspective. All right, price volatility. I want to just point out this particular VIX index. The rest of the skews, the price closes, and the 3-month averages. These are all helpful, but this is what I want to point out. That we really have a market that has been going down in volatility for the last 18 months. Lower and lower volatility. We do get spikes and then recoveries down to this extremely low level volatility. That is basically happening, I think, because of the lowering inflation and the more stable Fed performances in the bond market, which is why we'll talk about that later. But keep in mind that ever since the highs in 2021, the market blown out, volatility has been dropping, and that has been a lot of what's driving this market forward too. All right, the equity risk premium, I just want to point it out one more time here. It is extremely low, extremely low. Prior forward PE, it's up on this trend from 2010 on. It's getting up high, not at the highs, but going up, up, up over time, with the COVID pandemic being kind of the interesting little spot here. Nothing more to be said here. Just keep in mind, we really are at a valuation-driven market from the Fed perspective, pretty much what they cost. All right, now let's go to the middle of 24, macroeconomic setting for the United States. We do need to look at the fundamentals of the U.S. economy. Just want to point out that things are strong and things are okay. But let's get into some of the core elements of that. First of all, overall economic activity, the PMIs, let's just focus on the ISM PMI. Yes, it has been down in the 50s and just kind of toggling around here for the last bunch of time. This was to be expected after this run up. So this was supply shock driven. And like I said, you like to see this from the perspective, this took the goods price inflation down because we built up supply for a long time and now it's just cooling. And so the goods cooling here is keeping the non-rent price inflation down. And that is the really key point of view. Here's the PMI versus the manufacturing, and you can see it's more likely to show you that big surge in from a purchasing manager perspective. They bought a lot, now they're not. That was the supply shock. It is definitely over. It is not overdone. I mean, you got to get down below 45 here to, or 40 even, to really see, like you can see here with 40s, and the big spikes down below 40 is when you get recessions. It's certainly not the case right now. Okay. Disposable income and consumer confidence. Here's your disposable income. Doing quite well. Here's your consumer confidence present situation. It is off the highs at 160 down to 140. That's entirely because of the 20% rise in prices out of the supply shock. However, it's been stable now for 2.5 years. We know it was around a lot, but in general, since the pandemic, it's just been stable. No real sign that consumers panicking or not, and there is this ongoing growth in disposable incomes. No evidence that this is going to be turning over from the consumer perspective anytime soon. All right, gross private domestic investment and the price of Caterpillar stock. They're tracking one another. This is the other story. This is the infrastructure package. You can see it really did add a big jump here on the back of the pandemic. That probably was good policy because the goods price shock was coming off and the infrastructure spending was going up at the same time. Goods, employment and private domestic investment, that's physical production, probably similar employment types, and that was probably wisely done. Okay, the housing market. Home sales currently it's 600,000. The low is at 500,000 down here in 2022. We're getting down on very low sales of homes. Price of homes currently, 2% negative year on year. Certainly not the big plunge you would like to hope for. We're up and we're getting some activity back now. It was real low for a bit after, about 6-8 months ago, but not now. People are starting to buy some stuff at a very low level of sales. Month supply, 8.5. You worry about this when you get over 10, and we're not there yet at all. So I would not worry about getting a big plunge in the housing market anytime soon this year. Now, starts, units built currently somewhere in the middle of the range here. Again, nothing to be worried about. So it's a very low activity from a single family home sales perspective. There's a rising inventory and modest price issues. But in general, this is for the most part a very static, low volume market. And that's what I would tell you about housing. Okay, so now we're going to finish up with consumer price inflation and bond rates. Let's get through this. Obviously, this is the big story, and let's just step back and take a big picture perspective. Number one, tips. Tips are at 2.15. They are showing inflation-protected expectations are 2.15, which is, certainly not a great number. Over time, if you look back through this period when it was in those 0.5 area, the middle range is 0.68. That's the red line. We're way above that. So we've got an extra 1.5 from the tips perspective. And however, back in here, we got up in that zone a little bit. And so it is interesting that we're back over here a little bit. 20 years later, we're kind of there on the tips. Treasury yields, obviously, those are not actually as high as back in here. Those are actually higher. And then down here is CPI. This is what I wanted to show you right here. This is the goods shock coming off. And then you can see we're now at the current 3.4% on the all items CPI for urban consumers. Just notice this is actually stabilizing above that 2% Fed funds mandate right here. That is what they like. And the middle range is 2.2, so they'd actually like a little lower than that. And you can see we always did pretty well for 10 years. Now we're stuck. So the good shock is off. The rent static move at 3.4% is on, and it does not show any sign of going down. So bottom line is the Fed's likely to stay higher for longer because of this. As long as they care about this, and they do, we're going to be stuck in this for a while. Treasury yield curve. I want to point out, where we've been and where we are now. We had that huge rise in the Fed funds rate, and now we're just statically moving along. Everything's just kind of tight up here, which is like what you see before here, of course, and here when there were big recessions. Now, I would note here, it's when the cuts happen, then the recession goes a year later. That's the issue here. But the longer the Fed holds out, the more we push off these recessions from a yield curve perspective. Keep that in mind. There's been way too many people looking for the recession, and you got to have the Fed cutting hard in front of one for a year, and they basically don't get the recession done right. And that's really been the story. So keep your recession view. It's still out in the future, not this year. All right. So here is that story. Again, just back to the spread, the 10 and the 2-year. Obviously, it is inverted. Really more about the good story than anything. It's about a supply shock. Perspective on inversion. Keep that in mind. It's really different this time. You can see that over here. It's actually much deeper than it is back in the 2006 period. Okay, the rut. I want to point out, here's the Russell. Over the last 4 years, here's the Russell relative to the S&P. It's gone down, down, down. It all fell apart, of course, with the Fed hiking. So you can't bet on the Fed cutting until September. And if you don't get any cuts from the Fed, you can't get the Russell rally. Keep that in mind. RUT is more cash and rate recession than the S&P 500. Gold and silver, of course, you can see gold is in a bull market. And that is largely because of central bank buying outside the United States. That is really showing up the geopolitics. If you want a geopolitical trade, it's been gold and silver prices. That really has been the story here. Okay, so that's it for me. Thank you for attending. I am the Chief Equity Strategist and Economist at Zacks, and this is my mid-year update. So if you want to get hold of these slides, please give us a call, 866-794-6065, or send us an email at strategycall@zackspro.com, or find us on the web at www.zackspro.com. We have a LinkedIn page at Zacks Professional Services where this material is found. We also have a Twitter feed at ZA Tools. However, for things like this, this is right out of the Zacks information system. Give us a call, 866-794-6065, or send us an email at strategycall@zackspro.com.